Is growth slowing while inflation stays sticky? Here's what the latest U.S. data means for your portfolio in plain English. The economy cooled at the end of last year. Fourth quarter GDP was revised down to a 0.7% annualized pace, a sign momentum faded but expansion didn't vanish. At the same time, January's core PCE inflation ran at 3.1% year over year. Headline PCE was expected at 2.9%. That leaves inflation above the Federal Reserve's 2% goal, even as growth eases. Why does this mix matter? Because markets move on the balance between growth and prices. Slower output can pressure revenues in demand-sensitive industries. Persistent core inflation can keep financial conditions tighter if policymakers judge that price stability isn't yet secured. Together, these forces shape earnings, valuations, and the path of interest rates. For equities, softer growth often challenges cyclical areas like consumer discretionaries and parts of industrials that rely on brisk spending. Companies with resilient pricing power, recurring revenues, or cost control may hold up better if demand plateaus. Profit margins become a focal point when sales growth cools and input costs remain firm. For bonds, the picture is nuanced. Cooling growth can support high-quality duration if markets anticipate easier policy later, but core inflation at 3.1% argues for patience until disinflation is clearer. That tension can lift rate volatility. Investors often reassess interest rate exposure, balancing short and intermediate maturities while emphasizing credit quality when the outlook is mixed. For the Fed, 1 month won't decide policy. Officials will watch the trend, not a single print. Further moderation in core inflation would open the door to easier conditions. Stickier readings would argue for staying restrictive longer. Markets will likely swing on each update as the story unfolds across multiple months. What can you do now? Revisit your risk mix. Stress test your equity holdings for slower top-line growth and narrower margins. Favor balance sheets and cash flows that can withstand tighter conditions. In fixed income, be deliberate with duration and avoid reaching too far down the credit spectrum without compensation. Keep dry powder for opportunities if volatility creates mispricings. And anchor decisions to your time horizon, not the headline of the week. Want the full breakdown, charts, and sector implications? Read the full article at finlitica.com. Quick reminder, this is general information, not financial advice. Your money, your decisions, so always do your own research.